Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative here once again with the Last Week in Mortgage Today, our weekly walk through all the latest and greatest news and rumors and everything going on in the mortgage industry. Each week, I'm pleased to be joined by one of our lender members as my co-host. And this week, back again in the co-pilot seat, Nationwide Mortgage Bankers President, Jodi Hall. Jodi, thanks for joining me.
Glad to be here. Thank you, Rich.
Also this week, lucky to have our great friends at Stewart Title Guarantee, their National Director of Lender Sales, Rich Kugler. Rich, thanks for joining us today.
Thanks for having me, Rich. Looking forward to listening to you and Jodi this morning, so appreciate it.
Awesome. Well, we will appreciate your perspective today. Stewart, a very innovative partner of TMC that has been for quite a long time. We've used you guys in a number of different roles as subject matter experts. Why don't you tell our members a little bit about Stewart and what you guys got going on?
Certainly will. Thank you very much. So Stewart is not the 127-year-old title company that many folks think about. We're actually doing a lot to reframe our business, making some major investments in innovative technology, ways to bring the title industry forward and bring our customer experience to the forefront. We are adding different capabilities also in the appraisal space, made two major acquisitions toward the end of last year to expand our scale there. Also added a few competencies in closing and in e-signing and remote online notarization by the acquisition of Notary Camp. So number of things that we're doing, all with a focus on the customer experience. We realize that's a huge driver for our lender partners and in what's going on in the industry. So happy to be a partner of the collaborative, and look forward to talking with you guys again about what we can do to help your business.
Awesome. And I'd love it if you could just hang out, because one of the things I want to get into with Jodi this week is just, private equity and in general investment in mortgage fintech. There's been a lot of activity lately. I know you guys have been active in that space, so really excited to get your perspective on that.
Gladly.
Awesome. Jodi, before we get into a lot of good relevant topics that we want to discuss this week, just I guess give us an update. The general business climate, obviously rates ticked up a little bit, and you can't open a mortgage news email newsletter without seeing something about the inventory issue. It seems to be getting worse in the industry. What's the general business climate been like these last few weeks for you at Nationwide?
At the beginning of March, I was a little bit concerned because our applications had really taken a big dip over what they were the last quarter of 2020. But when you look at the percentages in the industry, I saw applications are down in the high teens. We're not experiencing that level of decline in applications. We actually had an increase in applications in March over February. And that's not just because of the long month. Those were, those were based on yesterday's numbers. So we're really excited about what lies before us in 2021. We were a primarily purchase company going into the pandemic. What we're seeing now is that our applications are taking that greater turn to the purchase business. Let's just hope that we can get those closed and there remain enough homes to purchase so that that trend can continue through 2021. But we're really excited about 2021. Our fundings are up over the last January, February, and March, about 250%. There's a lot to be optimistic about in an environment that is extremely pessimistic. It's very difficult to listen to any mortgage news and not get depressed. But we have to change the way that we think. It's psychological, right? Look at 2019. It was an awful year in the mortgage industry. We can't set our baseline at 2021, which was historically amazing from a revenue perspective. So if we kind of adjust our thinking and the psychology, I think we have a lot to be optimistic about in being mortgage lenders, especially if you're a similar size mortgage company to Nationwide Mortgage Bankers and what we're able to offer. So definitely a tremendous upside for us.
That's awesome. Congrats on the success in March. Not surprising. You guys have a great company, and yeah, to your point, I mean, even with some of the headwinds in the mortgage industry right now, I mean, pretty much every projection from any economist is projecting one of the best years, in recent history in the mortgage industry, just maybe not as good as the greatest year maybe ever last year. So great perspective. And yeah, there's a lot to be thankful for really in our industry. The pandemic, obviously had a lot of impact globally that was negative, but there's been a lot of positive that's come from it. And, I think all of us in the residential lending industry should really be thankful because it has bore some fruit for our industry. So, Rich, on the Stewart side, I know just looking at, I just went in and analyzed and wrote the executive summary for TMC Benchmark a couple days ago. And, just looking at that data, Jan and Feb were big app months, much bigger than December and comparable with November, which was a big app month. So as a result, we're seeing good closing numbers for our members in February and March. I had to imagine that this has been an action-packed start to the year for you guys as well, right?
Oh, big time. Yeah, I think similar to what Jodi's experienced, we've seen application volumes very strong throughout the first quarter. We had the same kind of concerns as February closed up and what kind of openings we'd have in March, but that continued to be strong. And we are starting to see a little bit of a switch in terms of what's projected with the refinance volume versus the purchases that we're seeing out in our local direct offices. So that's a little bit of a change, but definitely a strong first quarter, and a lot of those improvements that we've made in efficiency, I think and we've seen that with our lender partners as well, who've been able to, I think, improve their workflow as a result of the activities in 2020 to really put a priority on that and shortening cycle times where you can.
Awesome. Thanks, Rich. Jodi, turning our attention to the news headlines, I think the big news to me this week, at least just, in talking to our members, has been the focus that has finally been placed upon some of the changes that are starting to happen with the GSEs. Fannie Mae, kind of started the news cycle on this a couple of weeks ago by announcing a cap per lender, 7% of units sold. You could not sell more than 7%. Non-owner occupied investment properties, second homes. Then, some stories came out really highlighting the changes that were made in mid-January by Mark Calabria and the FHFA to the Fannie Mae preferred stock purchase agreement that has prompted these changes by the agencies, likely more coming down the pike. I've been talking about this on some of the other broadcasts that we've been doing over the course of the last week. And, some of the things in there, caps on lenders, what they can sell into the cash window over a rolling 12-month period. Obviously, the non-owner item that we just discussed. And I think most notably, a provision that says that the agencies cannot purchase more than 3% of refinance business, again, per lender, or 6% units sold that has any two of these three characteristics: a back-end ratio over 45, a FICO score below 680, or a combined loan to value over 90. So how did you react to that news, just seeing that? How will that impact your business? Talk to me a little bit about the non-owner piece. I've talked to some other members of ours that did an analysis of their pipeline, and I think some were like, 7-8% had to make some adjustments. Some were higher and had to make more significant adjustments. How have you taken the news, and what's your thoughts on the matter?
I think we in the mortgage industry react when we have to. So even though the news came out in January about the cap on the non-owner OC and the second homes, we didn't start reacting to that news until a couple weeks ago, because it's approaching quickly with April 1st. The first started just analyzing the data. So people typically have a very dramatic reaction to change. But when we looked at what we have in the pipeline, we're slightly over that 7%. but we started looking at individual loan officers, and there are a lot that have very high percentages of non-owner occupied investment properties. So I think we just have to be careful. We typically recruit purchase loan officers. We're going to have to start taking a look at what their product, besides their product mix, what the property type mix is for them when we do recruiting. And then we just have to be careful with the additional pricing that's being added by investors to help limit those numbers. I really think we have historically done a high percentage of non-QM business prior to the non-QM investors pulling out. I do think that we're going to see, whether it's non-QM or private equity, come in and fill that gap in the non-owner occupied and second home. What I think has a more dramatic impact is the limit on the 6% purchase, 3% refinance for what is deemed to be a high-risk borrower. Again, not immediate impact, because with historically low interest rates, I think I saw statistics that only 1% of home buyers in August of 2020 would be considered high risk. But as interest rates continue to rise, that's where more and more borrowers are going to be considered high risk. And what has me so fired up, I told you I was fired up about this yesterday, is there is a disproportionate impact to borrowers where when you look at 2019 HMDA data, a white non-Hispanic borrower will be able to qualify for 2 times more loans than a Black or a Hispanic borrower. So with what the administration is trying to accomplish in increasing equitable home financing to different demographics, it seems counterintuitive. And 30% of our loans originated because we have a DBA, AmeriCasa, but 30% of our portfolio is Hispanic home buyers. And what is going to be the impact? Is HMDA going to start asking for CLTV and DTI data so that we can, HMDA can regulate what it was intended to do, was making sure that there was affordable, non-discriminatory lending. It is to be seen, but that is the part that really is frustrating. I do think that it will direct more home buyers, as to what your question was about FHA, and more home buyers will probably qualify for FHA loans. We've seen a tremendous increase of people who qualify for conventional loans, and maybe the percentages revert back to the days of where you're 45% government and 55% conventional, as opposed to 75% conventional loans. But it's a hard pill to swallow. Again, it's changed so that your immediate reaction is more dramatic, but I think that we can adjust with it, and it's an even playing field, right? It's not like it's not like there is, where it is uneven is going to be the limit on the 1.5 billion in a rolling 52 months for larger lenders, but the rest of the regulation is across the board for FHA loans. So at least there isn't disparity in the requirements being placed on lenders.
Rich, you manage Stewart's mortgage lender relationships nationally. Any chatter from your client base on any of these agency-related changes?
Really don't have too much insight to add to what Jodi mentioned. I think the concern on kind of the product shift is certainly out there. I think the biggest question that we're seeing is kind of what's next in the application volume, and where should resources be focused, but nothing really else to add to what Jodi said.
And of course, these weren't changes that were prompted by the Biden administration. Mark Calabria, a Trump appointee. The change to the PSPA document was made Jan 15th, 5 days before the inauguration. obviously intentionally so. And, right now, there's a case in the Supreme Court. Calabria's job is he can't be fired by the president. That could change this summer. But your point, Jodi, is really valid. These changes that are now starting to come down the pike from the GSEs fly really directly in the face of, the bane of Biden's housing plan, which is home ownership, first-time home buyers, level playing field. And again, we're talking about a 675, 92% loan. This isn't, 2006, 120%, 580. I mean, this is, and, so it would stand to reason, right? That if these are enacted and the lenders cannot deliver more than, essentially 4 or 5% of their book of business to the agencies that have these characteristics, FHA is going to get a boon of business, right? I mean, all those, and I haven't been in the origination game personally for a while, but I remember when I was that borrower, that 5% down, 670 borrow, if you put them side by side, conventional and government, typically because of the cost of the FHA insurance, typically the conventional deal is the better deal for the borrower. I've talked before on this show and in other places that, a lot of lenders are putting those borrowers in FHA loans because they're more profitable. So now that would seem to encourage that even more, right?
Right. Absolutely. And, in pulling numbers, in what I referenced before, we are going to be pushing more loans to FHA. So just in 2019 origination numbers, the median FICO for a non-Hispanic white borrower was 752. Hispanic borrower 714, Black borrowers 694. So then you look at so none of those are below what the 680 requirement are, but you have to have a large percentage below to be at a 694 median score. Then you look at CLTV, your non-Hispanic white borrower is 90% LTV and the median CLTV is 96.5 for other borrowers. So there you have most of the population is going to hit one of those high risk factors. Then DTI is the third risk factor. And Hispanic and Black borrowers are 41% medium DTI. So that a large percentage of those borrowers are going to be at that 45% or greater. So FHA loan is the only place to go. And it is, and when you're looking at when you're looking at 6% of purchases and 3% of refis can be high risk, you're playing an unmanageable game, right? Like, how do you not direct a borrower who hits two of those factors? How are you not pushing them into FHA? Because how do you manage it? I mean, we talked about having to add compliance employees going into the Biden administration. Now, with what FHFA is looking at doing, we have to add cap markets. We need statisticians that can figure out the numbers and play the crazy chess game of the percentages, and then even the rolling 52-week average of 1.5 billion. I mean, it is, we're looking at increased cost as a lender just to manage it. Unless you are going to go the direct line, I'm not going to try to manage it, and I'm just going to push more borrowers into FHA loans. So that's the difficult part, and I do think that we're just having the wrong impact. I thought that if you wanted to, and it's always been, if you wanted to restrict lending, you add price. And we added an adverse market fee. FHFA added an adverse market fee to reduce risk. If you want to reduce risk for limiting the amount of second homes and non-owner occupied homes, then add to the pricing so that you're gaining more, and then you're able to use those funds to help borrowers and provide more to communities and first-time home buyers. And how risky is a second home today when people have tons of cash sitting in the bank and FICO scores are historically high. Same thing with investors who are buying up investment homes. If you limit 70% loan to value, do you really have a greater risk there? I just think that, and I said this the end of last year, not a lot of common sense going on in making decisions, and we're left, because of the industry that we're in, to be able to react and pivot and adapt to it.
Great points and perspective from the president of an independent mortgage banking institution. Just, some of the boots on the ground, real world impact on how these changes impact companies in our industry, and choices that decision makers have to make. One of the things that had been bandied about as part of to support Biden's housing initiatives was potentially a reduction in the FHA insurance premiums. That would seem to be tougher with more business coming in. Of course, we've got a CFPB now that's placing a big focus on fair lending. Yet you have the GSEs, making guideline changes that make it tougher for that fringe borrower. So a lot of moving parts, to be sure. It's going to be very interesting to see how this all plays out as you have kind of, the transition from one administration to the next. The actions that were put in place at the end of one and kind of fly in the face of the goals of the incoming. So this is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. Pleased to be joined this week by Jodi Hall, the president of Nationwide Mortgage Bankers, and Rich Kugler, the director of lender sales for Stewart Title and Guarantee. And I want to shift our focus to emerging tech. And I got two great people to speak on this issue here. You can't, talking about mortgage news headlines, you can't read any mortgage media source without seeing something about somebody raising money. There's been so many private equity investments in mortgage technology these last 6, 7, 8 months, but particularly these last 3 or 4 months. TMC, we started an emerging technology fund back in November. We're seeing and feeling this, getting lots of looks. Stewart, you guys are a very tech forward company. I know you guys have made some acquisitions in the emerging technology space. Rich, would just love your perspective on the mortgage fintech climate in general right now, where we're at, where we're going, what you're seeing from your seat.
Certainly. Yeah, no, thanks. I think, as you mentioned, Rich, we've made some acquisitions, but I think more interesting is the fact that we've made decisions not to make a number of investments and acquisitions as well. What we're seeing out in the market is that there is really a flood of opportunities. There's an interest from a lot of private equity coming in to try to make some investments and really piece together what has been emerging as a
Rich, you froze up on us.
And start at LO.
Nope, we're losing you, Rich. Well, while we get that figured out, Jodi, I'm going to turn to you here.
There's also been other.
How appropriate when talking about technology.
Talking about it, Rich. I'm the mute Rich just for a second while we get that figured out. But Jodi, you've talked on this show and others. Rich, we'll come back in 1 second. We're kind of breaking up there.
Sure.
Just about, the dilemma as a business owner of a tech forward independent mortgage banking company, the whole like buy versus build dilemma, which is a very valid one. How have you reacted to some of the recent news headlines, just about all the activity in the mortgage fintech space, and what have you guys been up to in that arena?
So I feel like 2020 was the great fast forward of technology, because we had so much business that everybody had to react. And if you weren't implementing some technology fix, then you were going to fall behind everybody else. So we were a tech forward company before 2020. What has happened 2020 and 2021 is now there are so many players in the game. It really has made it even more difficult to make decisions as of build versus buy. I do think that we're a mortgage company, right? We're great at originating mortgages. I feel like we're going to let tech companies do what they do. It's going to be, what is the partnership going to look like? And I think that that is largely what is going to evolve over 2021, and the relationships between fintech and lenders, whether that is that they consolidate and, tech companies own mortgage companies, or even banks, but making the decision just became much harder with having so much availability to technology. I would say that probably I spend in a week's time, I probably spend 2 to 3 more hours a week, first quarter of 2021, even than I did in 2020, vetting technology. So looking at buying solutions to put into our workflow to increase efficiency, because there are a lot more possibilities today than there were in 2019, and being able to vet all of them and make a decision has become a lot harder than it was before. And you also, our CTO uses the analogy that you're skating towards the puck. Well, I want to skate towards the puck that is all the way down the ice, 5 years from now, not from what it's going to look like at the end of this year. So that's what makes making a decision even more difficult than just reacting which is what we were doing in 2020.
Absolutely. Yeah. We're already seeing lenders undoing technology solutions or platforms that they bought a couple of years ago when it was the next big thing. So it's certainly important decisions. And Rich, before you broke up, I think you were starting down the path of a point that Jodi, I think, also made, that you mentioned that you had made some acquisitions, but you also chose not to make a lot of acquisitions. And we're starting to talk about just some of the challenges of there being so many different options and alternatives in the mortgage fintech space. So I'll hand it back over to you.
Most definitely, and apologize for the technical issues. Yeah, so I think as Jodi really said well, is skating to where the puck's going to be is very important, but it's also important to prioritize what's going to allow you to get there. Technology for technology's sake. So the focus really has to be on, how do
You're breaking up again. Zoom must not like the necktie. Zoom's not used to seeing neckties, Rich. That could be the problem. So you're breaking up again there. We caught most of what you said. Maybe the last 20, 30 seconds is what we missed there.
Yeah, I was just going to say that was the best part too. Was just that now, really analyzing how do you string a lot of different components together the right way to drive the customer experience has really been our focus, and I think the focus of a number of our customers as well.
Excellent. This is the last week of Mortgage Today. I'm Rich Werbinski with the Mortgage Collaborative, joined by Jodi Hall, a Nationwide Mortgage Bankers, and Rich Kugler of Stewart Title Guarantee. And just a couple minutes left. I want to touch just briefly on home values. They're skyrocketing. There's report after report. The latest was existing home sales 16.5% up year over year. That seems a little elevated to me. I've chronicled on this show, I'm looking to buy a house right now, and it could not be a worse time. I was looking at building a house, and essentially if you're building a house right now, just argument's sake, say you're building a $500,000 house in Northeast Ohio, you're paying basically $80,000 more than the home is probably realistically worth right now. When you factor in the inflated prices of lumber, likely inflated, at least slightly, home values. So I'm sitting here like, man, I really would like to build a house, but can I it seems like a bad investment. Home values in general. Jodi, I'll start with you. Your thoughts on just the home value acceleration madness.
Well, I'll sell you my house. I'm going to move to a barn now.
That's right.
It's it's interesting. I just I think that you knew I'm building a farm, and we signed a contract with a builder to build a barn this summer in January. I just got the revisions for the build cost last night, and I was looking at it this morning, up 21%. From signing the contract in January for just because of the cost of supplies. I have a really close friend of mine works for a builder, is a regional sales manager for a builder in South Carolina. And she was telling me that her competitor that's building developments adjacent to the developments that they're building, they're canceling contracts. So contracts that they wrote, they're like, there's no way we can build the homes for this cost because of the prices. So they're just canceling them, which we're just going, it's to be seen, but I think it's you can wait, you're not homeless, right? So maybe.
Yeah, right. I have my problems, but
But I do think we'll see people waiting, and trying to get out of contracts. Because my first question was, okay, this is up 21% from what I originally signed. Can I get out of the contract because I have a home? My horses have a home, so they don't need a barn. And I think that we're going to see a lot of consumers having, the same thought. And, do we continue to rent until the market is stabilized and there's more availability of existing homes, or there's more supply for the builders so that the building costs aren't as high?
What came to mind for me, when talking to this builder was like '08. I remember, I was working for an Ohio bank. We're doing a lot of business in Florida, a lot of construction business, and people were building homes, building $600,000 home, pre-meltdown in Florida. And then, the home's halfway done. All of a sudden it's worth 400,000. They're just like walking away from a half-built home. Rich, the senior brass, yourself and others at Stewart, any that keeping you awake at night at all on the settlement services side?
Somewhat. I mean, just because of the overall impact on the market. We like to think that real estate is very local, but there are a lot of local markets that are undergoing the exact same type of impact. And certainly the building costs for new inventory, the availability of existing inventory, all issues to have to consider.
Excellent. Jodi, Rich, enjoyed the conversation. I appreciate you guys joining me.
It's great to be here. Ready to be back in person for sure.
Absolutely. Yeah.
No doubt. I ditto that. And thank you very much for having us.
Well, that's good opportunity for me to remind everyone. TMC Summer 2021 at the lovely Terranea Resort. I'm actually headed there momentarily, just outside Los Angeles for a very vital site visit / mental health excursion for me. But September 19 to 21, going to be a spectacular event. I think everybody's looking forward to seeing each other in person. And Jodi, great perspective at the beginning of this call about we kind of talk, a lot of the headlines have been negative in the mortgage industry lately. Shows like this, we talk about the headlines, but the grand scheme of things, I think the worst case scenario is still a great year for the mortgage industry. Something to really keep in mind. And to our audience, thank you for joining us once again. Every week, Tuesday, 2 p.m. Eastern, the last week in Mortgage Today. We'll see you next week. Have a great rest of the week, everyone. Take care.
Thank you.
Thanks,
Bye.
Rich. Thanks, Jodi. Bye.